Welcome to the podcast, and on video, of course, it's Paul Hill, full-time investor, equity analyst, always on, never sleeps. He's like the crypto markets; they never go to bed. When do you sleep, Paul?
Sleeps for whims, remember, Justin.
Yeah, exactly.
And Wall Street, you say never sleep, so you can't be. You've got to be on your game. But no, to be fair, what I do is I tend to go to bed reasonably early and then get up before sort of the Asian market starts, so just after the US has closed. But that's me anyway. What time do
you go to bed? What time?
Well, I've always been an early riser, so I tend to, whenever I'm tired, to be honest, if I've had a couple of glasses of wine like I did last night, it was about 8 o'clock.
Okay, well, that's almost as bad as my wife. My wife is a really early to bed person, an early riser, even earlier than me, and I have to get and do stuff in the morning. But yeah, that is early. That's good. It's but yeah, but you know, I do envy that. I do prefer the mornings to the evenings. There seems to be more going on, and you can get things done and research. There's no noise around, isn't there? So it's quite nice.
Oh yeah, I mean, absolutely. I mean, I typically, you know, I suppose my average time, I mean, it varies a lot, but average time is sort of 2:30 in the morning, and you pick up all the US close, and then you get obviously what's happening out in Asia, and then you have a look at the futures market to see what the prep is for the indices to open, and hardly anybody. Actually, fair, there's a few people around on social media occasionally, but it's sort of like it gives you a chance to absorb all the major information, what's been happening, particularly after hours, sort of like, you know, big blue chip US corporates reporting, what that means for the for similar businesses out in Europe, etc. So it gives you a good steer about what you then expect, and then when you obviously the RNSs then start tilting at 7 o'clock, you've already got yourself
you've been up for
set.
half a day by then.
Yeah, exactly. Yeah, no, there's many a time I've done 12 hours before it even started on the 7 o'clock RNS. And then you go through it, obviously, a mad hour or an hour and a half going through all those. And then the markets really start trading from 8 o'clock, or really from 8:30 onwards, when the liquidity sort of hits. But
yeah, I do love that. So I love about the stock market. So life is a game. The stock market is a game, pretty much. And it's almost like, under starters orders at 7 a.m., the news comes out, and then they're off at 8. But what I like about that, US is so influential over the rest of the world, in the UK. And we saw that yesterday with American figures, CPI figures, where they came in sort of better than expected, and the UK markets rose.
They just took off.
I know and it's almost like, I'm not saying this is the vaccine day that we had where everything rallied in the world, but it did feel a bit like that. There's a lot of positive liquidity came in the markets, and I thought, wow, it's amazing the influence. It's like the moon and the world with tides that the American markets have over the UK. So it's always worth watching that. And Europe with the foxes and the owls. There's no one else around.
Well, no, it's amazing. What's also incredible is that you and I are so similar, because I had the same thoughts yesterday, when the sort of like the market before the sort of the US CPI print was sort of relatively flat, a bit up, etc. Anticipation that it was going to be a softer than expected number, and then say at 1:30 when the number came out, it just took off along with the US, and it was game on. I had a sea of green on the desk, which I haven't seen for about 18 months. So yeah, it was great fun. But it seems to have a bit more realization this morning.
Yeah, that is good when it comes below expectations. What was it? Core CPI in the US was like actual was 4.8. Forecast was 5% for year on year to June, and month on month again 0.2%, and it forecast to be 0.3. And previously it was 0.4, and again for year on year is 5.3. It's gone down to 4.8. So that is very good news there, and it does suggest to a certain extent that once you start slowing this down, it seems to, I mean, of course, this is cumulative very much, but I mean, it is slowing quite quickly. And that's what I'm worried about over here. I'm thinking, I do think that super tanker analogy may come into effect. I don't know about what you think, but it's like I do feel to a certain extent
we're heading towards that coast.
Yeah, we're getting towards that coast. It's half a mile away. It takes a mile, it takes a mile and a half, 2 miles to stop this tanker. Slow it down, reverse it, and I think it's very hard to predict, in America.
Yeah, no, it is absolutely. I mean, there's two major points I would, sort of like highlight to investors. First of all, I still think the labour market needs to crack to get a sustainable level of CPI at 2%. I.e., I think it will come down sharply, no doubt about it, on both sides of the Atlantic. Obviously, we're lagging in the UK. But if you get sort of the goods inflation and services inflation dropping, just because demand sort of tails off, the problem you get is that when it does fall down to get to that 2%, it's got to stay down there, and it won't unless wage inflation gets to sort of like 2 to 3%, which was before the pandemic, unless we get sort of like, supercharged productivity because of generative AI or new technology, which is possible, but it's never really happened on a long-term basis. Yeah. So we need wage inflation down. So that'd be the first bit, I would say. But the other one, which was chime with what you're saying on the CPI, is that sterling now is 130 versus the dollar. Now, given we import in the UK a shed load of sort of like goods and products and stuff like this, then actually that is a good deflator, because that input cost inflation is going to come down, or disinflation.
And China did, wasn't it? Didn't China's CPI go down, I think, recently?
It was zero, China, actually.
Yeah.
It was, yeah. And it certainly it was heavily negative on the goods inflation, on the PPI. But actually, the CPI was zero, I think, last month. So you're right. The issue you have there actually is that they had a sharp expansion in GDP in the first quarter, and then has really sort of rapidly slowed off in April and in May, and that has actually impacted some of the PMIs in Europe, and that slowed down quite a lot of the the German economy in the second quarter as well, in particularly the big exporters. So it's a difficult one. We came into the year expecting China to be a home run. It's going to be a similar sort of like story as it goes reopening to the US and Europe. It hasn't happened. It only was a 3-month effect. The housing market's still a drag out there. So the world's second biggest economy, if it starts to slow down, it is going to continue to impact, China, etc. So you've got to look at it in the global GDP bit. It might be good, to be honest. It may be good if we get this sort of like, mixed GDP worldwide, then inflation worldwide should actually start to fall, and you will see sort of wage inflation quite often. If that's the case, and it happens over sort of 6 to 12 months, then the market will look past that into the better times ahead for the back end of 2024. And maybe we don't get a big correction. Maybe we get a slowdown and a mild recession. And frankly, who cares? Because the company should be able to survive that. The issue you have is that if you're in a business that's heavily indebted, lots of borrowing, the zombie businesses in Europe and the UK, they're not going to have been able to stomach 5 or 6% interest rates, no chance, because their borrowing costs are almost like, they're the worst type of high yield or junk debt, and therefore they're paying like 12, 13%. They've got pretty tight balance sheets, and they just can't afford the interest. So that's going straight into the hands of people like Begbie's Trainer and all the other insolvency specialists in the UK.
Do you know what? I saw something interesting yesterday, and this has been talked about, the mortgage time bond, how impactful that will be. But this guy, John Byrne Murdoch, he was the economist and chief data reporter of the Financial Times. He punched something out yesterday, and it caught my eye because he was quite good on the old COVID stats, amazing statistician. But he said the UK mortgage time bond numbers are bad enough, but they're really sickening when you think of them as an effective pay cut. And he said an increase of £500 in monthly payments, coming to 1 million households by 2026 is £6,000 per year, which equates to about £10,000 pay cut. I don't know, we looked that up, but he's got a graph there, and he's saying essentially, like I said, this lag factor is happening, and that's the problem. We may see a slowing economy for a long time if you keep interest rates high and people keep obviously renewing mortgages. That's the worrying thing, is the lag factor. It often takes longer than we expect, So we may have. I see a rally happening end of this year, and then also a rollover next year, because all this these high cost of living will actually hit home to many people.
In a rally in what though? Rally in where and which sectors, which type of stocks?
Well, essentially UK stocks, of course, were at an all-time low. I think so many companies now really good value, and I just think technical rallies and then momentum piling, money piling. It's hard to say individually, but.
Well, I hope they're in yours and my portfolio.
Well, exactly. I mean, but I don't think we're going to have good growth going forward. But again, it's odd, isn't it? Because like-for-like figures, if we got bad, for example, GDP figures now, they're listless. Like I said, they're going nowhere. I mean, I looked at the last 7 months or 15 months of GDP in the UK. 7 have been mildly positive, 7 have been negative, 1 0. And in fact, in the last few months, we've had April has been 0, May has been -3. What's June going to bring up? But then again, any positives, it'll be a good like for like. When it's the worse those figures get, the better like for likes get. So again, it's hard to say. It's so many moving parts. That's why at the end of the day, all you can do, I suppose, is look at individual companies and think, hang on, that is very good value. They got cash, they don't not much debt, and that's all you can look at, I suppose.
Well,
It's
I mean, the
hard. Trying to predict with the macro, it's always been very hard, isn't it? Doing it in that way, all you can do is look at individual.
Yeah, I mean, I think if you and I have to, and everybody, serious investor has to actually predict where we think the macro backdrop is to be able to get a feeling of how the businesses that we invest in are going to operate in that. But we have to accept that, frankly, it is a guesstimate. It isn't going to be exact, no doubt about it. But coming back to your point in terms of sort of the GDP has been pretty flat line, and it's difficult to actually see which companies are doing well. Well, one business came out with results, about, was it this week, the week before, Supreme, which does sort of like affordable FMCG products in vaping, lighting, batteries, and sports nutrition. And they knocked the ball out of the park. I mean, their results to the end of March were actually in line, but they announced a sort of like a big blockbuster distribution deal, which was basically going to take some other number one brands, vaping brands across the UK as for distribution and for manufacture, etc. That'll add about another 2 million of EBITDA. Plus their existing business, particularly in sports nutrition and vaping, was doing better than expected anyway. So they upgraded their expectations and on profit, and they're looking at top line growth of around about 15-16% for next year. So I mean, I did the sum of the parts on the actual business, and I mean, I used a very conservative estimate. I was getting 195p per share, and the shares not surprisingly ticked up, and they were trading above £1.10 after the results. But again, that's still very good value, and because it's in that nice sweet spot of affordable everyday products, they have good visibility. And they're best in class because they've just consolidated all of their distribution and manufacturing into a big RDC stroke factory in Trafford Park. So they'll get economies of scale, and they're pushing greater volume, and they have more volume, more capacity to put other products in, whether it's through M&A or through these types of licensing deals. But the vast part of their profits is still comes from their own brands. It was about 2/3 last year. But the CEO, Sandy Chahar, I mean, he's really entrepreneurial, and he's got a solid balance sheet. I mean, he had about 3 million of cash if you strip out the FRS 16 sort of like notional leases, etc., just on the straight cash. So they've got plenty of firepower. They're generating lots of cash, in fact. I mean, if you look at their cash flow yield,
90 million of operating cash flow.
Yeah, well, it was actually last year. If you looked at the market cap before the announcement, it represented a cash flow yield of 13%, but I bet it's still around about 10-11%. That's just fantastic. I mean, that just gives you all the firepower to invest in the business and to M&A, and with attractive assets at reasonable prices out there. I think he's going to do it again because he's that sort of organic and acquisitive growth strategy he's done. He's done. It's been fantastic. The business has really grown. So yeah, you can find really good value with strong. I mean, 16% like for like growth. I mean, that's not too shabby.
Mm-hmm. Yeah. Is the worry there about perceived maybe for regulation coming in to as regards vaping and all that stuff? Because I mean, we've got two areas we know it. First of all, it's better than smoking cigarettes and getting tar in your lungs, and if you can switch to that, vaping is going to help you a lot. But of course, you've got a lot of teenagers taking it up, and people are worried about regulation coming. I look at the chart. Yeah, wow, it's going in a range, pretty much a range of it almost broke out in those numbers. They came back in 93 pence to sort of 115, and it's gone up and down in that range. Pretty much dipped a little bit down since June 2022, and then on the numbers, it broke out. And then it came back into the range, which is annoying. I mean, that's the market, though. People will take profits. If they see something rising, they've had something sitting in their portfolio for a while, people will take profits and say, the risk averse, I'm just going to want to go cash. And so until we break up that, it's a sentimental change. It's a psychological change we're in. People will almost go to cash a lot in this market. When people start holding on to the stock, we'll start seeing a rally, maybe a bull market. But I mean, we are in that bear market mentality where people will take a profit on anything.
But to answer your question, I mean, it raises a fabulous point, in terms of vaping with that risk in terms of the political. Actually, if you look at Supreme, they are best in class in terms of compliance. I mean, just to give you two examples. First of all, they test all the products which come through third parties in terms of the vaping. So they make sure that obviously they've got the right quantities, they're not overstepping on nicotine, for instance, and they meet all the rights, whether it's disposable or not, etc. So they've got all the actual regulatory tests. That's all the products that go out the door. So that they're perfect in that respect. But also what they've started to do, because of the problem the government has, is that it's the retailers, the corner shops who have been selling, vaping products to underage people. They may not know they're doing it, but anyway, what Supreme is doing now is actually going to be randomly testing, spot checking the retailers to make sure they're in compliance with.
That's good.
And
they know, and they know that these retailers. My son, right, he's 13, and around our town around us, there's none that will sell them to kids of a certain age. Because there are one or two shops in Southampton you can go to, and they know where they are. They won't ask you their age, so that those people need to be shut down, or warned or fined or whatever. Yeah.
And just as an indication of the sort of the level of reassurance and compliance that the Supreme have in this area, I mean, they take it deadly serious, etc., is that those two large UK vaping brands, Elf Bar and Lost Mary, I bet you, I mean, I don't know, I didn't say it in the announcement, I bet you that was one of the main swing factors when they came to choose Supreme as their distribution partner, because this is a major contract, and to be able to offer those services reassures those brands for their distribution into the UK. So they are, I think they're totally best in class. And actually, I mean, I've spoken to Sandy about this, and he says, bring it on, because he doesn't want these flipping cowboys in the industry. He wants them out. Vaping is a good product that takes people off tobacco, which is how he markets, their products, the 8.8 vape, etc. And that's what it's aimed to do. He doesn't want it he absolutely doesn't want it with underage people. Totally doesn't. So, he's on a mission to effectively not only grow the business but clean up the industry, and I think he'll do it.
No, when you are leading regulation that are ahead of it, then that's exactly what you want, because you don't want industry players being suddenly clamped down on by the government. So if you're ahead of them and you're above their standards, then that's where you should play.
But that's as good as any, and it's still on good value. I'd have to work it out what the price, what the PE is, but I bet you it's way below 9 times still with cash on the balance sheet. So something to have a look at. I mean, another one which came out with a trading update year end this morning, and I know we've talked about it a few times, is Avingtrans, which is that specialist engineer that does those blast-proof doors and also those high-integrity security boxes for the likes of Sellafield. Well, I mean, they've come out some fabulous contract wins all across nuclear, and this is a huge growth area that I've highlighted before. It's about over a third of their business. They've got some contracts in the States, in Poland, Sweden, and also in South Korea, whether it's sort of like new sort of like state-of-the-art types of nuclear fusion, or whether it's sort of life extension for existing facilities. I mean, this is like a whole bucket of really great contracts, and what that means is that currently they have a record level of orders for this time of year, because there's a bit of seasonality associated with it, and gives them great revenue visibility for the next 12 months. So they've met expectations for last year. Fantastic. That's on the cash generation side, the EBITDA and the sales. And they've reiterated expectations for this year, which is a nice lift in revenue and in EBITDA, and it gives them enough money to invest in their healthcare business, which they also said today that they're putting. They've put a proposal to buy the remaining 82% of Adaptix they don't own from the sort of majority shareholders. Now, the board at Adaptix have to actually follow their articles of association, and therefore ask for other offers from other parties if they're interested. And I think the final bids are going to be in on the 21st of July. But Avingtrans already own 18%, and this Adaptix business does small form 3D X-rays for the veterinary markets and also for small gynecology, not gynecologists, basically orthopedics. So it's revolutionary technology, which also fits with their Magnetica business. So it looks like a perfect deal to me. Avingtrans get the chance to beef up their healthcare business, plus get 300 odd, treasure trove of IPR, and Adaptix get access to capital at a really difficult time where there's this drought in VC funding, plus get sort of like industry expertise from the likes of Magnetica. So it's a great deal which they hope to close. I think this is really gaining momentum because it's not only now going from a sort of like a long cycle nuclear energy type business that has really good visibility, which is excellent on its own, but it's also now adding on a high potential sort of medical healthcare business that's not priced into the shares at all. So I think it's another one which, it's a great company. There's no doubt about it. There aren't many businesses which are talking confidently about their outlook at this stage, given the uncertain macro backdrop. And these guys can see that revenue visibility and profit, generation.
Yeah. It's just odd, isn't it? How everything's sort of suppressed. Like I said, they've been in a trading range pretty much since, July 2021. And but having said that, from the dash for cash crash, it went from 190 or £2 up to 460. So it did move a bit there. So maybe there's a bit of congestion.
But if you look at the
range,
if you compare it to AIM over the last 18 months, Treading Water's not been a bad result, actually.
Yeah, exactly. If you got one or two of those in your portfolio, it's a relief, honestly, because most of AIM has gone the opposite direction.
And what that says to me is that there's quite a few shareholders who have made a good turn on it when it had during the pandemic, and it went up to like £4, etc., or £4.20 from £2.50. They've quite a few of them have dropped out, taken the profits, but there's been a solid level of institutional buying, wanting to pick any sort of loose stock up. So I think there's a strong floor to this. I think it's just gone through that classic consolidation phase, and it's ready for a kick up into the next part of its development. It's got sort of like it's got, was it 13-14 million of cash on the balance sheet. So, it's got plenty of firepower to do further M&A.
Yeah. Well, it's always nice to have a bit of cash on the balance sheet. Oh, by the way, I was speaking to, I mentioned Trufin, and they raised some money, and they raised it at very little discount, which is very good because they've got big shareholders, and that's always good. You should always look at that, when you have small cap companies, have they got supportive, institutional investors, and they've got something like Watrium, another big investor as well, will always support them. And
they've got, I think they've got Gresham House in there, who's very active, and they've got Gervais Williams as well is in there. There's quite a few. I've spoken to a few fund managers, and they all speak very highly. What price and what price did they, as in share price, and how much money did they raise?
They raised about close to 8 million, and around about 65 pence it was, or 64 pence.
Good number.
And that's the same. If you look at the chart, that and Avingtrans, it's very much gone. Since the last year or so, it's gone exactly the same. But what's interesting to see, they raised the money for Mortal Shell. I got a bit. Don't know if I'm right to say this bit, but Mortal Shell, is one of the big hit games, and people release games, and what you want is a hit. And when you get Mortal Shell, came out with from a standing start, no fan base, sold 1 million units, and now they've got a big fan base of over 1 million people, and pretty much waiting for Mortal Shell 2. Now, Mortal Shell 2 price point is 30% higher than Mortal Shell 1, plus there's a bit extra gaming time, and they've got internal estimates. They reckon will do 2.5 times what Mortal Shell 1 will do. So once you get one hit, that's the hardest bit.
Yeah.
Then you got everyone chomping at the bit, all the fans waiting for Mortal Shell 2. So they basically acquired the franchise, the rights to develop and license Mortal Shell 2 and 3. And they generated about 15 million in revenue just from Mortal Shell 1. So you imagine what Mortal Shell 2 is going to do. So, it's a canny bit of a play here, just to raise 8 million to secure those two franchises. And that's just one part of the business. And James says, I think some people have forgotten, about PlayStack, because Target's taking the limelight, and Oxygen as well, having an offer But Chicago, we're starting to release games this year, and with Mortal Shell franchise coming online, I think next year after.
Is it a mobile application, or is it basically on the PC for Mortal Shell?
I think it's PC. I think it is. Yeah.
Okay.
It's quite an in-depth game. I mean, I'm not into that kind of gaming.
The mobile's the where it's really happening. Actually, that's the sort of the really.
Well, having said that, all the big, it is first on the go. But if you look at all the big gamers and the reviewers, it's always on PC or on Xboxes. But on top of that, platform deals as well. They do, with Microsoft and all that stuff. So this is a game changer. And PlayStack is going to be profitable, I think, this year anyway. This on top now is going to really supercharge that. And
do you still own Trufin?
Yeah, I still own them. Yeah, I mean, it's almost like one of the things they don't shout about this stuff, but things are ticking up. Like I said, Chicago, and there was a suggestion. He said Chicago, of course, signed up with Lloyd's and who else is it? Who else is the company? Lloyd's and
there's Sage in there.
Sage, that's it, I couldn't think. Sage and Lloyd's, two FTSE 100 companies, and that's now they're commercializing that. And they did say that Chicago's going to raise money. And the suggestion is, because Lloyd's have already put about 5 million in, to it. I think it could be another investment by Lloyd's, or I think at the end of the day, Lloyd's will take him out.
They should. I mean, it makes perfect sense.
Yeah.
It's just it's agreeing the price, isn't it? I suppose.
Yeah, but it's almost like they started off with 4 companies, pretty much all loss making, and now 2 of them, Virtus and Oxygen, are profitable. PlayStack will be profitable very soon, and then soon after that, it's going to be Stargo. So that's a good hit rate. 4 companies.
I mean, I actually think it would do the share price a power of good if they sold one of those divisions, whether it was Oxygen or Stargo, for a good number, just because it would prove the business model that you invest, some money in a franchise or in a product that you believe in at a low level, and then you invest in it, and then get it to a position where somebody else can take it on at a much higher price. So I mean, that would make perfect sense as a model, to go forward, give shareholders a lot of sort of like, reassurance that this is a repeatable process.
Yeah. Well, Oxygen, of course, there's invoicing for local councils and that. So early payments for local councils, and it's the visibility on revenue is phenomenal. It's like they can see the next 5 years, 88-90% of their revenue coming in, and they had an offer back in when was this offer for it of 22nd of December for 26 million, and it seemed like, wow, that's quite a big chunk. It's in revenues at the moment are small, but they're incrementally growing all the time. And all they have to do is keep adding, contracts. They are the number 1 provider through our local authorities, and it's quite easy to build the revenue. And it's so much in advance to the visibly 3 to 5 years down the line. And we know where this is going. We don't want to sell it yet because it's only just building and building and building. So the longer we hold on to it, the better it'll get. So because I thought that 26 million of cash would be quite nice.
Well
I thought, but,
well done. That looks good. I mean, the one company I own as well, actually, which came out with a good half-year trading update, is EQLS. And I know we've talked about this before, but 43% increase in revenues to the half year at 45 million. And they've got 50% sort of like gross margins, and they're indicating it's going to be 20% EBITDA margins, all big improvements on last year. And frankly, I mean, offline, I spoke to the CEO, Ian Strafford Taylor, and said, really well done. This, the business is doing well, etc. And then he basically stopped me dead. He basically said, I want more, and I just thought, this guy's on a mission. He's not happy with just very good. He wants flipping exceptional performance. And that's the kind of person, that's the kind of hunger I really want to invest in, even in a business that is knocking the ball out the park. You have a leader like Ian who is just driving his troops to basically, effectively, get the gold medal on the 100 meters. And he's just like doing a fabulous job already, but he's still not satisfied. He's not prepared. He's not going to rest on his laurels until he can really sort of like see this one go. And he absolutely believes in it. He's done a great job so far. So that just gave huge reassurance. And then with the margins going up as well, the brokers didn't actually move any of their estimates. They're going to do it, I think, at the half year. When the interims come out in September. But if you just double sort of like, 45 twice, you get, and without any growth, you get 90. And that's higher than where Canaccord are for the sales figure. So we're going to get further upgrades, no doubt about it. I mean, I pushed mine through on a modest level, but got about 92, 93 on revenues, etc. And I get 168p per share. Canaccord, I think, are on about 164 or 160 or something like that. And the other house, I think, is Singers, and they're on about a similar sort of number as well. So we're all about there and there, sort of 160, 170p per share. There's a lot of sort of firepower here. And they completed their Unex acquisition, which is their beachhead into Europe to lift and shift this best-in-class straight-through processing international payments platform into the European Union. Now that'll take time to sort of really get sort of going, etc. But certainly by next year, it'll be likewise. It'll be doing really well, hitting the ground running. So yeah, there's lots to play for, and 43% in quite a difficult market in the first half is actually best in class. But it was that reaction. It was the reaction which just gave me confidence from Ian, and that was offline. He was just not, he was the business has done really well, but we want it to do better. And I thought, wow, that hunger, that desire, that tenacity, is what I want to invest in.
Yeah, it's it's going to break that pound level. It keeps going up. Like I said, the head results. When was that? Back in May, was it? Because they broke up above that quite nice at the 110, almost 19, 109. And they came back into the range again. Again, in a bull market, it wouldn't have done that. And now we're at 99.8. It's determined to push through that resistance level. It will get there. It's tried it so many times, but eventually it'll blow through it, I suppose.
Yeah. Well, he actually gave me some, paradoxically, a bit of a nice problem. I've been saying for 6 months now, because it's my largest position, I've got to trim this, okay? But when I spoke to him, I just thought, there's no chance I can trim this. I mean, it just is like, I'll be just cutting my own throat and I'll be regretting it for the rest of my life. But what I've, as I mentioned to before, I've bought quite a lot of technology, and I've bought some sort of like capital markets play. So I put a full position in TPI cap on, as I mentioned last time, and also bought Sondrel, the semiconductor sort of bespoke customer AZEC chip maker and designer. And I also had a position in GB Group as well, which is a stealth play in AI. So what I had to do, I mean, I've looked at my portfolio and I've had to rebalance. So I've actually now sold out of Argentex just because of risks, sort of like sector focus, etc., and also FD Technologies. Now, FD Technologies is the one which is a stealth, another AI play, and I love the software, and I'm probably going to be sort of like regretting that one as well going forward, because I think that's well positioned. And likewise with Argentex, they came out with a half-year trading update, and I interviewed the CEO, Harry Adams, and they did top-line growth in the first half of, I think it was 28%, and they're expecting a big second half with increasing margins. The cash is fine as well. So, they're absolutely on track. They're expanding internationally into Holland and into Australia. So they've got that international expansion, and they're putting on this, sort of the technology with their I-band, multi-currency I-band, similar to what EQLS has done. So they've got a great sort of like footprint for long-term expansion. But it was just portfolio rebalancing. I just have a huge weight, a massive weight in fintech, software, AI, and technology. And I mean, I know I've got broad shoulders and I look long term, but frankly, it's just becoming a sort of 1 or 2 sector portfolio. And I just need to sort of like take my foot off the gas, and I love it. But there's a danger that you just get too lopsided on your portfolio. Healthcare, technology, AI, software is where I love it. Go up shares, no doubt about it. But I just had too big a weighting, so unfortunately I had to sell FD Technologies and Argentex. But you have to make those hard decisions. I mean, sometimes, even though you'd like to, if I didn't own EQLS and all the other software stocks and AI stocks, then I wouldn't need to. But no, I was just too damn big in that position, and I need to redeploy it into effectively other areas that don't have too much correlation with those big areas that I love.
Yeah. Well, I've made a buy this week.
What did you purchase?
It's a revisit actually, which first time I got in, got out, it broke down. But I've made the plunge on FUTR again. FUTR PLC.
I was going to say that was the because you'd been sort of intimated you had to get back in. I'd have bet a lot of money you were going to say that.
Yeah. No, I put a decent chunk in there for me anyway. But it's I've been looking at this going down, and I thought it needs to be some kind of catalyst here because there's just so much negative sentiment about advertising, and then on the PE of 4.5 at one point, and like I said, good cash, very good margins, and a cracking business, and a new CEO comes in. I like the cut of his jib. He's a brash American New Yorker, and he put 880 grand in at
wow.
So
about half the amount you've put in.
Yeah, but literally, so he bought 90,000 shares. He had £8.80. 90,000 shares is £8.80 put in, and literally. They announced today, obviously that's hurting him a bit because they announced this week they're going to do a share buyback. Now they've never done that before, so they literally, they go for growth, organic or inorganic, and they said, but we decided to put 45 million in the share buyback, but we're going to look up to get permissions for up to 10%, which is around about 96 million. And I was thinking, looking at it's starting to rally, and it broke above a certain level. I thought, right, I'm in here because I think that's put a floor under the price. To start buying this, it's going to change the sentiment massively. I don't know if there's any shorters on it or whatever, but that they're going to stop. And it fundamentally is undervalued. And it started to rally, which is nice. I sort of started buying it. I think it was like at about where did it break up above? Yeah, 730, 740. It's now £8.06.
Well
so
done.
It's above 50-day moving average, and I do start, and the buying hasn't started. I just looked at the average daily volume. I thought it's about 5 million a day pounds.
What's the RSI on it?
Well, the RSI.
Yeah,
it's 64, and it's not done that before since. In fact, last time it broke 50-day moving average, it did 25%. But I think this is now the bottom. I mean, it may have gone sideways a bit because if you look at its average daily volume, it's about £5 million a day. Right now, if you take into account, say, around about half of that is sell, half of that is buy, but on the downtrend, it's probably more sell. But they've got now some. That buyback is equivalent to about 20 days worth of 15, 16 days worth of buys. So the sentiment will change on this now, and also just coming into the market to buy those shares will help. And the fact that it's going to work and put a bottom on this, and the CEO is still in the game. He's about 30. Well, he was about 30% down at one point, and he was thinking, "But we've got to do something to turn this around because it's awful." But they've got certainly they come from 40 quid down to £6. 30 odd, and I'm thinking sometimes.
What's your view on AI, generative AI, with regards to the business? Is it going to be a beneficiary, or
yeah, I think there will. It's like already, like when he first came in, did his first sort of presentation on the interims. He was showing examples. He said, "Ask me." He had people there, a live presentation, and he's asked me a question. I would type it into the AI, so he's using AI on the website. And like I said, as I think one of your guests said previously, the source of the material is searching for on the internet, will also come from websites, good websites that are still communicating properly. And I think they're already into AI. He's very tech focused, and they've hired a sort of head of tech guy there. So yeah, they are, here. But just based on, this was previously, trading on PEs of 20, 30, and now it's 4.5. And even if you put a PE of 15 on it for next year, you're talking 100% upside here. And so, EBITDA of 10, and the operating margins are 20% plus. It's like they are a good business. Be oversold a bit. So yeah, hopefully it'll be upward trend here, but it seems to have broken the downtrend. That announcement of the share buyback and going up to 10% of total shares bought back.
No, I would agree with you. I mean, from just all fundamental measures, it looks hugely undervalued, and you wouldn't, at this level, these prices, you wouldn't be surprised if somebody had a shot at it, and to even just to break it up as a sum of the parts, because it just seems hugely sort of, it just becomes a distressed asset, and it isn't. It's basically generating cash with good margins. So I mean,
last set of net margins, like for the interims, was 14%. And so it's one of those ones. It's one of those ones where, years back, I wish I'd gone into that company. It's a great business, operating cash flow for the half years, 87 million, and so it's I quite like it. It's one of those ones. It may be a bit volatile, But I think this guy, the CEO, I quite like him, and he's really, almost this is his thing, and he's got money in, and he's going to make it bloody work. And I
yeah,
quite
that's
like
what
his
you need. You
brashness,
need you need a highly capable, experienced CEO who puts a lot of skin in the game, and then you've got really somebody who's motivated, and he'll be passionate in terms of convincing his rest of his team that we're all moving in the right direction here. So you
and
need that.
It's America. America's been a growing market for them, and the stats are phenomenal. It's like 1 in 3 websites you look at are owned by FUTR. That's how good their websites are. They are best in class websites, and they go compare and all that. Marie Claire, 250 highly branded websites. So that's and he did say, he said anyone would love our portfolio if we got great websites. And but it's nice to see this. So hopefully that's going to make a move there. But
and how much cash do you have now then, Justin, left over?
10%.
10%.
Yeah.
10%.
Yes, I gone down from, I think, was it 39 or 40%? Yeah.
Wow, God, you have.
I have topped up on what else? I topped up on. I topped on something else as well. I think I topped up on Good Energy, which I mentioned because I think the valuation is ridiculous, and they're going in the right direction of going from a energy supplier to a service provider, where you are, quadrupling the margins there, and on 300 million revenue turnover, and they got 20 odd million in cash, and literally they are. In the right area, they are like a 28 million market cap, and they got 20 million in cash. They own 49% of ZapMap, which is the growing EV charging. It's the leading market leader for EV payments, charging stations, all that stuff. I just think it's crazy, really. And I think it's maybe I don't know why it's gone down that far, but I've chatted to the management, and I like the CEO. He's ex-money supermarket. He knows his stuff. And they've got this, they're acquiring businesses with higher margin, and they're going to scale those. I mean, heat pumps, solars, all that. And it's 180,000 customers supply them with electricity. And I see that the way forward, decentralization of energy. Is that people will be generating their own energy and putting it back in, all that. And that's the way forward. Smart meters, smart apps, all this stuff. It's amazing stats they have as well from ZapMap, and they're now selling that data back to EV users, because they're the biggest data aggregator of EV charging. But they're just in the right space, and the fact, I just think that's nuts. They are literally I don't know, the EV is ridiculous, their enterprise value. It's negative almost, but I think they've got that much cash to deploy, and they're literally growing a little bit. They're profitable, they pay a dividend, and they're heading in the right direction margins wise. So I put a bit more into that, I think.
You're definitely getting more bullish than if you've got only 10% cash, aren't you?
Part of me thinking, when we hit the recent lows, I thought, is that the bottom? Because, and getting in the right cyclical timing of when everyone's bearish, having some cash, and that's where I was. And now I'm starting to deploy a little bit, because I think, is it going to get a lot worse? And we did see that the FTSE, I do hold a fund with FTSE 250, FTSE 350, and that was even down like 7%, and that's quite stable. And then that really rallied yesterday. It was at like 2%, which is like quite big for and I thought, okay, we may have seen a bit of a low here. And I don't think that even UK figures are not going to be a lot worse than what we're seeing. The markets are way ahead of the actual real world. We know that because the markets have sold off for the last 18 months. They've been predicting all this. So we are close to a near bottom, I think. You're never going to time it properly, but we are close. We've got to be close.
I must admit, I've got to tip my hat to your understanding and expertise in capital, sort of like, the markets with regards to the psychology of how it moves, because, you always sort of like, are looking at how things are positioning and all this sort of stuff. And, I think lots of investors go, I do, thanks for all this, because it chimes with how I'm seeing it as well, in terms of, I think we have reached a turning point, a bottoming process for small caps. Who knows whether it could go down further, but actually, if you've got a long-term time horizon, this could be a really nice moment, 2 or 3 months to pick up some over the summer, to pick up some more shares. And I think getting in ahead of that turning is better than not getting than having to wait and then try and get in, particularly in small caps, because the volume's just not there. The liquidity is never enough to get in, when it does start to turn.
Yeah, well, the odd thing is like, have you started Threads yet?
No, I haven't. No, but it's boosted Meta's share price.
Yeah, well, it's 100 million users already. Now, Twitter has 450 million, and Threads only been going for a week. So it's amazing. But no, I didn't put, I'm on there. All I said, I'm going to use it for something. I don't know what, but I've seen posts in quotes, just stock market stuff. I just thought the other day, I was walking the dog, I thought, do you know what? Towards the end of a bull market, it's a point where investors are prepared to pay more for overvalued companies, and towards the end of a bear market is where investors won't buy any more of undervalued companies. I think that's the wrong way around psychologically, and you realize, okay, you may not get the timing right, you may be off by 6 months, whatever, but you've got to look at the value on some of these companies thinking, will you get that? You won't get that in the bull market. There'll be multiples of where they are now.
Yes.
And so you just sit back and just,
and it'll move quickly, and there won't be the volume to get in either. So I think you're exactly right. It's better to be early than late, because you can't get in otherwise.
No, exactly.
You just see this thing racing away, and you're always hoping that you're going to get a consolidation or a drawdown, and it doesn't. It just runs away from you. So as long as you choose carefully, I think you find it's a real. I mean, again, with just coming back to Trufin, it's a good statement of the company given the squeeze on small cap fund managers and their difficulty raising cash. Then actually to raise 8 million for a Trufin, you at a good price as well. That says everything, because there aren't that many businesses being able to get that type of money away. Yeah,
exactly. Well, I can see, there's some nano caps and micro caps I'm looking at I quite like, but I've been looking at their, their last trading statements or their last set of results. They need cash desperately, and the share price have rallied quite a bit. I think, why aren't they raising cash? It can't be easy still, because they are quite sort of newish, these companies. I mean, it must be very still. It is still. We see that there's companies delisting now. There's a couple of companies who are almost going to delist. In fact, yesterday there's a app called Fiinu. It's called the bank is the ticker, and they had a sort of an overdraft plugin. So literally, you wouldn't have to move from your bank. If the bank refused you an overdraft, you could use the plugin. So they're going for a banking license. They can't raise the money. As simple as that.
They need one of their products.
Yeah. But it's looking now like they're going to go to the wall, because they're shutting everything down. They've cancelled the application for a banking license, all that stuff, and that happened a lot. You can see it. Companies are struggling. So when you see companies raising money like Trufin, you realize they've got good support there, and that's the kind of companies you want. I know it's still hard out there.
Good. Oh, we've got the Q2 earnings season kicking off tomorrow with the US bank, so that'll be full on from then. And then we go into back end of next week. We've got the big mega cap, the Magnificent Seven sort of tech stocks. By the end of July, we should have really got through most of the barrage. But the next 3 weeks is really going to be heavy lifting, and I think that's where the rubber's going to hit the road. Not so what they say with the expectations for what the results are for Q2, because I think as a totality, the market is expecting about 7% decrease year on year. But it's really what their outlooks are, Q3 and the rest of the year. And that's really going to be, to me, it comes down to how much of their borrowing costs gone up. Is the pricing power still sticking? And if they're hoarding employees, which frankly they still are, then what does that mean for margins? Because their sales will be declining and then their cost base will still be up. So personally, I think there could be softness towards the back end in the earnings side. Whether that's going to make any difference to the market, I'm not sure, because I think it'll probably see through it. And then it's all really what's going to happen in 2024. There's quite a lot of big jump in earnings. And I think it's very believable if, this is the bullish side. It's the 10% increase in EPS for the S&P 500, which is baked in for 2024, is very believable if wage inflation comes down and the Fed starts cutting interest rates, because that will reduce the borrowing costs and allow companies to effectively reduce their input costs as well. So
well,
plenty of different moving parts.
Yeah. There's also, I think next Wednesday is CPI from UK CPI data, so inflation data.
That's going to be a frightener, isn't it?
Yeah, 8.7% at the moment. But do you know what's odd? I did buy my sons. I bought them both in their junior ISAs. Regular amounts of the S&P 500 fund, basically. And really? I did that. Yeah, I did that when the Golden Cross happened, because I looked back from the 1980s as far as I could get data on a chart, and literally 79% chance of the markets rallying higher from a Golden Cross when the 50-day moving average crosses up over the 200-day moving average.
I thought that was a pub round Winchester.
What's that?
The Golden Cross.
yeah. But it's look at that. But essentially, it's a uptrend, you know, because you've got so they're doing very well on their little junior license, better than I am in my account. It's really easy.
That's because the S&P 500's done great this year, hasn't it? On the back of those big
I keep saying,
stocks.
you wait until UK stocks turn, and then I'll be beating you. But as yet, they're outperforming me.
I bet they say, Dad, this stock picking lark is pretty easy, really. What are you doing? You know, get your life sorted, mate. What are you doing every day?
No, exactly. How can you spend so much time and you're losing money? We don't do it. We go to school for making money. Cool. All right. Thanks for that, Paulie.
Yeah, take care. Speak to you in 2 weeks.